Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, welcome to the deep dive. We're embarking on, well, quite an intense exploration today. The market session we're looking at is just full of these extreme contradictions, almost illogical ones. You've got U.S. equities hitting these, euphoric, historic highs, all this AI optimism.
Right.
But then on the other side, central banks are making some pretty surprising big structural moves, and geopolitical tensions are simmering away, kind of quietly reshaping trade.
That structural split is really, the core of what we need to unpack today. Our mission, based on the prepared resources, is to synthesize this diverse stack. We've got info covering U.S. and Asian markets, key currency pairs like EUR/USD, USD/JPY, U.S. equity indices, S&P 500, NASDAQ, Dow, and the big economic sentiment drivers. The goal is really to provide a structured summary, help us all cut through that information overload.
Okay, let's unpack this then. And, well, we absolutely have to start with the fireworks on Wall Street, right?
Yeah, what happened in the U.S. session was genuinely monumental.
Monumental is exactly the word. We saw something so rare, it barely registers. All four major U.S. benchmarks, the S&P 500, NASDAQ, Dow, and the small cap Russell 2000, all hitting fresh record highs at the same time.
Yeah, the input sources highlight this kind of unified optimism. It's only been seen about 25 times this whole century.
Wow.
And the last time was way back in November 2021, nearly 4 years ago. It really shows the rally isn't just, the mega cap tech story anymore. It's broadened out.
But isn't that kind of breadth, that unified high, isn't that sometimes a bit dangerous? Historically, don't these moments sometimes come before a sharp pullback? Did the sources mention that risk?
They absolutely do acknowledge that underlying risk, yeah. But the short-term driver, it just overwhelmed any caution for now. The catalyst was very specific, that semiconductor shockwave.
The NVIDIA Intel news.
Exactly. NVIDIA announcing that huge, $5 billion investment in Intel?
Yeah.
To co-develop next-gen chips and data centers.
And Intel shares just went ballistic, up 22%. Biggest jump in almost 4 decades, wasn't it?
Incredible jump. And it even created this accidental massive windfall for the U.S. government's stake in Intel.
Oh.
Its value potentially shot up to around $13 billion, just like that.
So that's the euphoria side.
That's the euphoria. But here's the contradiction, right? Almost immediately after this huge news, Intel gets hit with a downgrade.
A downgrade, why?
From Citi analysts, based purely on valuation. They pointed out that even with this landmark deal, Intel's now trading at nearly double the forward PE ratio of NVIDIA itself.
Wait, hold on. They secured this massive game-changing partnership with the biggest name in AI, and analysts immediately say, too expensive. Does that mean the market's kind of blinded by the NVIDIA halo and the analysts are trying to inject some reality?
That's precisely the concern being flagged. The market priced in the partnership's success instantly, regardless of current fundamentals, which feeds right into that whole debate about the tech giants, the Mag 7.
Right, the Magnificent Seven. What's the latest thinking there?
Well, speaking of valuation, there's a Bank of America analysis mentioned in the sources. They argue this perceived bubble, well, ironically, they think it's still growing.
Still growing.
Yeah. Both have looked at current metrics versus historical peaks. They say the Mag 7's current PE is around 39 times, which is actually well below this historical bubble peak of 58 times.
So their conclusion is?
Their conclusion, more room to run. That's the quote.
Wow, that's a pretty strong vote for momentum. And it ties back to what we said earlier, that broadening rally, the Russell 2000 surging 2.5%. There must be a core belief driving all this, right? What's the market thinking?
There is. The underlying belief seems to be that the Fed's recent dovish talk, the rate cut, it's being seen less as fighting inflation and more as protecting domestic growth.
Okay. So growth protection, not inflation fighting.
Exactly. And that interpretation is key. It's fueling risk appetite, powering the rally, especially in those domestic growth-focused small caps, the Russell 2000.
Okay, so the U.S. is running hot on AI and growth hopes. But we need to shift globally now, because elsewhere, particularly in Asia, it looks like they're bracing for something quite different.
Absolutely. We pivot from U.S. exuberance to structural normalization, specifically in Japan. The Bank of Japan, the BOJ, their policy decision was mostly expected. They held the benchmark rate steady at 0.5%.
Right, that was priced in.
But the shocker was the announcement. They're going to start selling off their massive holdings of ETFs. We're talking about a book value of around $250 billion.
Whoa, selling off that mountain of assets. That's a huge step towards normalization. But the market reaction seemed kind of confused at first. The Nikkei dropped sharply.
It did, over 800 yen at one point, though it clawed some back to close down about 0.6%. And yeah, it hit stocks with big weightings in the index like fast retailing pretty hard.
So why the confusion? If it's normalization, shouldn't that be clearer?
Well, crucially, the BOJ tried to cushion the blow. They outlined an incredibly gradual pace for these sales.
How gradual are we talking?
Get this, some simple math suggests that at the pace they announced, selling everything would take over 100 years.
100 years? Seriously?
Seriously. Governor Ueda even commented that he and the current board won't be around to see the end of it. It's like starting a marathon where the finish line is literally a century away.
Okay, that's quite a signal.
It's brilliant central bank communication, really. Show commitment to reducing the balance sheet, but do it so slowly you don't cause immediate panic.
But even with that slow pace, the pressure for actual rate hikes must be building inside the BOJ. We saw that dissent.
Exactly. That was significant. Two board members, Tamura and Takata, actually dissented. They wanted an immediate hike to 0.75%.
So the hawks are getting louder.
They are. And that dissent, plus the ETF sales signal, has the market on alert. Even though Japan's core CPI actually slowed a bit down to 2.7% year over year, the slowest in almost a year, it's still stubbornly above the BOJ's target.
Okay, so how did the markets price this in, the probability of a hike?
The OIS market reacted pretty swiftly. It raised the odds of an October rate hike to basically 50-50.
And the yen?
Well, the yen initially strengthened, hit 147.20 against the dollar, briefly on that normalization signal. But then it gave back those gains pretty fast once the market digested just how slow that ETF sale will be. Plus, ongoing domestic political uncertainty there.
Right. Okay, so moving from central bank shifts to geopolitical drivers, the U.S.-China relationship was a big focus in the source materials, specifically that upcoming phone call between Presidents Trump and Xi.
Yeah, the main thing expected from that call, according to the inputs, is nailing down the final details of the TikTok deal.
The sale, right, to U.S. investors.
Exactly. Sale to a consortium of U.S. investors, ByteDance limited to, a maximum 20% stake? Beyond that specific deal, the bigger tension point is whether they extend the current trade truce. That truce is pretty important for global shipping stability.
And the friction that already exists is causing real pain, isn't it? That FedEx number was startling.
It really was. FedEx forecasting a massive $1 billion hit to its profit this year.
$1 billion. Wow. And that's mainly down to changes in the de minimis rule, affecting shipments from China.
That's what they're attributing it to, yeah.
Could we just quickly explain for us what is the de minimis rule and why does messing with it suddenly cost FedEx $1 billion?
Sure. It's actually quite crucial for e-commerce. The de minimis rule basically lets low-value imported goods, things under a certain dollar amount, come into the country without paying duties or going through intense customs processing.
Okay, so it speeds things up for cheap stuff.
Historically, yeah, it's facilitated huge volumes of cheap, fast shipments, especially from China, direct to U.S. consumers. So changing that rule, or even just scrutinizing it more heavily, adds costs, slows things down, creates friction. And that hits FedEx's bottom line directly, hence the $1 billion profit warning.
Got it. And that friction isn't hitting everyone equally, is it? There's that weird rare earths situation.
Yeah, the rare earths paradox, as it's being called. China's rare earth exports are apparently at record highs. But at the same time, the EU Chamber of Commerce is reporting that European companies are facing severe supply bottlenecks.
Bottlenecks leading to production halts.
Dozens of them, yeah. They're worried that U.S. companies might be getting export licenses much faster. It just highlights how these U.S.-China tensions create really complex, uneven ripples across global trade.
Okay, let's pivot to Europe, specifically the UK. Some pretty grim fiscal data came out.
Yeah, fresh data showed significant weakness. The UK's August budget deficit just blew out, came in at 18 billion.
And the forecast was?
Much lower. Forecast was around 12.5 billion. This was actually the largest August deficit the UK has seen in 5 years.
Ouch. And how did the markets react? Sterling, gilts.
Predictably negative. The British pound dropped, briefly touching 1.3483 against the dollar, and gilt yields jumped higher. The 10-year gilt yield rose up to 4.71%. It just underscores the huge fiscal pressure the British government is under right now.
Okay, so shifting back to currencies more broadly, there's this interesting paradox the sources highlight. We've got stocks at historic highs, big central bank pivots, bonds swinging around.
Right, lots of action.
But currency market volatility seems historically low. How does that work?
It is extremely counterintuitive, isn't it? Given all the macro and geopolitical risk floating around, the explanation seems to be rooted in technology, actually.
Technology. How
Right.
so?
Electronic trading advancements. They mean that sharp price swings, even after major U.S. data releases like those recent jobless claims numbers.
Which dropped significantly.
Yeah, dropped the most in 4 years. But even after news like that, the price swings now converge instantly. That's the term used.
Instant convergence. What does that actually mean for us watching the markets?
It means the friction, the inefficiency, is basically gone. Algorithms and high-frequency trading sniff out any tiny price imbalance, even on a big data surprise, so incredibly fast that any temporary volatility just gets crushed before a human trader can really react, often within like 30 seconds.
30 seconds, wow.
Yeah. So you end up with this strangely quiet, super efficient FX market, even while there's all this drama happening in stocks and bonds.
Interesting. And speaking of that jobless claims data, you mentioned the drop. The market took that as confirmation of U.S. labor market stability.
It seemed to, yeah. Interpreted as stable despite, some underlying acknowledgments in the source material about potential technical glitches in how that data is compiled.
Right, always caveats with the data.
Always. And this actually brings us to a really crucial sort of longer-term warning, something that puts that whole U.S. equity rally into a different perspective.
Okay.
Ray Dalio, founder of Bridgewater, he issued a pretty stark caution about U.S. debt accumulation.
Ah, okay. Dalio's warnings always get attention. What's he saying now?
He warned the U.S. is currently overspending by about 30%, and this necessitates issuing something like an estimated $12 trillion in government bonds.
12 trillion.
12 trillion. Without, and this is the key part, without sufficient global market demand to actually absorb all that debt.
That's an astonishing figure. 12 trillion needing buyers that might not be there.
He views that imbalance as a profound threat, a threat to the whole financial order, potentially. He noted it could very well determine the end of U.S. financial hegemony, especially if we keep seeing trade friction and these kinds of structural shifts from other central banks.
Wow, okay. That's the ultimate counterpoint to the Wall Street Party, isn't it?
It absolutely is.
So if we try to pull all these contradictory threads together for us, we've got a clear picture emerging, right? The U.S. market seems to be running almost purely on AI momentum and domestic growth optimism. That's shown by the record highs across indices, the belief the Fed's got their back.
Exactly. That's one side. But that enthusiasm is now bumping up against two pretty hard facts. First, major central banks like the BOJ are taking real structural steps towards normalization, even if they're doing it incredibly slowly.
Right, 100-year player.
The 100-year plan. And second, geopolitical fault lines are definitely deepening. That's impacting global trade, it's impacting fiscal stability. Look at the UK's budget shock, the trade friction hitting companies like FedEx.
So it's an inherently contradictory world for investors right now.
Absolutely. Exuberance on one side, quiet structural realism building on the other. That divergence is really defining things.
And that divergence is what's directing capital flows. Now, if we want to look ahead at what's coming up next on the economic calendar, we should check investing.com. They've got the upcoming schedule. Looks like we've got Canadian retail sales data, China loan prime rate updates coming up soon, among other things.
Right. And maybe as we wrap up, reflecting on this contradictory market, consider the long-term weight of those two figures we discussed. The BOJ's 100-year ETF exit plan and Dalio's $12 trillion debt warning.
Yeah.
What does it truly mean for global financial stability when one major central bank has to plan a century-long exit from its interventions, while another major economy faces a potential debt crisis that, as Dalio suggests, could determine the very end of its financial dominance?
Powerful questions for a really complex world. Okay, that brings us to the end of this deep dive.
A lot to think about.
Definitely. Thanks for watching. Don't forget to like and subscribe.